greet you all in the name of our Lord Jesus Christ. My name is Timothy Niwakawa, a student of Bachelor of Science in Accounting and Finance, Uganda Christian University, Year 3. This is a short video of what I've understood from my research and how I've explained it in my own way. So, the topic of my research is how the Uganda Securities Exchange can be influenced or has been influenced by the banking sector as a medium of trade. Well, when I was first doing this research, I thought that was the way it was going to be, but I found out that the banking sector can indirectly influence the stock exchange. What do I mean by indirectly? In Uganda, there are very few people who bank, and so very little people have knowledge about the stock exchange, except the younger generation which is being trained and which is being availed information and data to pick interest in this sector within the country because it has a lot of profitability. Then I realized that yes, when you look at companies listed on stock exchange, you consider one thing: the capital structure. What do I mean by capital structure? I mean the cost of capital the company is using, the amount of cash flows the company is using. I mean by cash inflows and cash outflows, money that is coming in, money that is being spent within the company. I mean financial leverage, the debt to equity ratio. And then I also mean the financial control that the company has over its assets. Well, factors that determine the capital structure or that affect the capital structure of a company: we have tangibility of assets, we have the growth opportunities of the company, we have the business risk that the companies are facing, and then we have the profitability index or rate that the company is going to gain or share with the shareholders. Now, Modigliani and Miller, back in 1957, believed that the market value of a company is not dependent on the capital structure. But when we look deep into this and compare it with the banking sector, all what I've stated can be affected by banks. What do I mean? Cost of capital. If a company can increase its cost of capital by talking to a bank can buy in shares in the company and give it capital so that it can have a stake in the company's what? The company's stock. What another thing? Cash inflows, cash outflows. The bank can influence the cash inflows. It can add it on capital so the cash inflows are more, which will allow companies to do more operations and operate faster. Financial leverage. Here it's self-explanatory: equity and debt. The bank can provide capital which can be confirmed as debt at the company, which will help it run operations. Because when you push your debt higher, you have higher capital to finance other operations that you couldn't do when you had your own equity. So debt comes as a form of additional income, though sometimes it affects the end of your gross profit. But as the theory states, we do not consider taxes, we do not consider bankruptcy costs, and we do not consider other transaction costs. Then, as I would like to come to a close, stock markets in Uganda, the capital structure, we used fundamental analysis within the research work. This fundamental analysis it had earnings per share. We're looking at earnings per share, dividend prospects of the firm, expectations of the future value of the firm, and the risk evaluation of the firm that is used to determine the stock price. When investors are looking to invest in a company or to make its stock price go up, they look for what they call financial statements. Now, as companies are going public or being listed on the stock exchange, they have to disclose out all the information. And we follow this according to the Sarbanes-Oxley Act. We follow some other standards that are used currently. Now, when an investor comes to your book and sees higher leverage and sees good working operations, sees gross profit is going up, they're going to be tempted and they'll be forced to invest in your company. The more investors that you have in the company, the higher the stock exchange goes. So what I realized from this research is that banks do not exactly directly influence the stock exchange, but they have a very, very, very important playing factor, because liquidity is the most important thing on the stock exchange. That is the most important thing. As long as your shares and capital are liquid, investors will be forced to come and invest in your stock. Now, to attain liquidity, you must have enough flowing cash and income within the company. To attain enough flowing cash and income, we also need the help of financial institutions, because sometimes equity is being put at use for other operations. So we need that extra income and cash to help other operations flow. Like I said at the beginning of my video, banks are the largest financial institution that we have in this country, and actually the best option that we have. Just that the only problem that we face is that some companies cannot borrow a lot of income because they don't have enough collateral to live with the bank. So it becomes a little bit difficult for banks to issue out guarantees or to issue out those kind of loans, or something of that sort. But this research has been really good. I have learned a lot, and it has been my pleasure conducting this research for Uganda Christian University and for my own personal basis. Thank you very much.